Two types of rental properties pro investors own to build wealth. Hey gang, this is Mike with MrNoFluff.com. In today's class, I'm going to talk about two types of rental properties for cash flow versus equity and building wealth. Okay, so let's go ahead and get started, guys. The first thing I want to talk about is that in the rental business, okay, rental houses, there's two types. And when I first started out, I didn't understand this to after many years of being in business since I started in 2006, fourth quarter. Okay, the first one I want to talk about is what I call cash maker. The first type of house is called a cash maker. Okay, this type of home will generate you massive amounts of cash per month, every month. Okay, that's the positive part. Okay. The negative part is that this type of house doesn't really appreciate in value. What does that mean? That the prices don't go up over the years. Now, they may increase, and they probably do increase in value because of inflation, but it's not a high demand area that people wanted to pay more or will pay more over time. Okay? So it doesn't go up in appreciation. All right? So again, this type of house gives you massive cash flow on a monthly basis. Now, let's talk about the other rental houses. The other kind of rental house is called what I call a wealth builder. Okay. And this type of home, you're not going to get massive cash flows, but you will get positive cash flow if you structure right, like I teach it in my mother course at MrNoFluff.com. Okay. And so my other courses. So you're not going to get massive cash flow. The other thing is, on the positive side, on the flip side, that you're going to get massive appreciation. What does that mean? So I bought a house in a very Pacific area of Dallas, right by the lake, very close to downtown Dallas. I hold on to it just 7 years, and it went up over $150,000. Okay, if not more. And without any, I didn't upgrade it. I didn't do anything just by holding on to it because so many people are moving to Texas, and so they're just getting flooded. And I'm close to uptown. I'm close to downtown, and there's nowhere to build, so the house values go down. Some people may buy very far away, and there's when you look around, there's a bunch of grass out there. So that house is not going to appreciate as much as a house where there's no more room or there's more demand now or it became a hip area, whatever. I'm not going to get into why houses become hip or the areas become hip, but just know that there's two types of rental houses. One is called cash maker, and the other one's called wealth builder. Okay. Now, on the wealth builder, well, before I explain this, I want to make sure you guys understand that when I talk about rental houses, I'm looking at two things. One, positive cash flow. If it doesn't have a positive cash flow, I don't mess with it. Now, there's people that I know that are very wealthy and they buy negative cash flow properties. They even buy negative equity properties, and that's because they need tax shelters and they need to write off stuff because their companies make so much money. Okay, but for the majority of people, when we invest, we want to get a return. We don't have like three other businesses or a business doing mega fine, and we need something to shelter us from paying so much taxes. So we buy properties that maybe have negative cash flow, or maybe buy properties that have negative equity, but at least we own something instead of paying to the government. Okay. So when I talk about rental properties, I'm talking about having positive cash flow and it has to be passive, right? So it has to be positive and passive, the two P's. So in rental properties, again, there's two types. There's the cash maker and the wealth maker. Now let's talk about the difference between them, okay? In a sense that the areas, what types. So on the cash maker, you're gonna find these kind of properties usually in what I call the C and the D areas. Okay, what does that mean? So if I could classify areas or classify properties in A, B, C, D, A's being like brand new, they're the greatest, no one living there, just a couple of years old, and D's being like in a bad area, war zone, ghettos. So if I could classify them, cash makers are in the C and D usually areas. Okay, for example, the price range. Okay, now every state is different. I'm just looking in the states that I've visited and I've lived in. Let's say for example for Texas, you know, you can pick these properties up anywhere from 30,000, up to 100K. All right, and they could range from anywhere from Oak Cliff all the way to like Arlington, Texas, all the way down to like Grand Prairie and of course the other benefits is that you're able to buy these properties at a very low price at like $30,000, $40,000, $50,000, and this property will give you a positive cash flow at least of $1,000 a month. Okay, so the money benefit is that you for 30 grand or 40 grand, 50 grand, you can buy houses in the C and D in the war zones or bad parts of town, or it just could be an old part. It doesn't have to be like really bad. There's a lot of parts that are just old and the area is safe. Okay. But they're older homes. Um, and they give you a massive amount of cash flow. They're like cash cows. They give you a lot of cash flow, even if you have a note on them, even if you have a mortgage on them, your payment's gonna be very low and you're going to get a good cash flow from it. Even if you own it free and clear, or if you have a note, doesn't matter. You're going to get massive cash flow. They're very small investments to get them. The cons of it is that you're in a bad area. Another con is it doesn't go up in value that much. Like in 10 years, that property that's a cash maker versus the wealth builder, it's going to be a marginal difference, significant difference between the appreciation. Okay. The other thing is that with the cash makers, your audience is different. So now you're gonna have a little tougher audience. People without college degrees and bad credits and etc. Not saying that people that are in the bad areas or different. Or there's good and bad and rich and poor, but you're not gonna get a professor. Okay, where if you're in the A and B, you'll get a professor, you get a doctor, you get you know people in the higher food chain in the economic wise sense. Okay, not saying that one is better or worse. There's again both sides. I'm just saying if you want a cash maker, it's going to give you a massive amount of money. So before I go dive into it, so let's keep continue moving forward. All right, now you're going to find these in C and D. They're usually very small price in acquisition, and they give you massive cash flow. Now let's do on the wealth builder. How do they look like? Okay, they're going to be usually in the A and B, okay, areas. They're not going to give you massive cash flow. They're going to give you just low passive cash flow. Okay, if this is going to give you $1,000, and this may only give you 200. They only give you 300. Now, on average, I'm not saying that you can't go find a deal in this area making 500 because that's what I did in the last recession. I went to wealth building areas, bought A and B type of properties, and I made $500, 600, 900, etc. Okay, from these properties. All right, and I bought it in a recession. But you can buy properties that give you massive cash flow in the wealth builder. But normally, on the average, the general investor, the general public, they're not going to get that. If they buy it in a wealth builder, like nice areas, all right, the homes are, nicer, newer, then they're not going to get massive cash flow. They may break even, get a zero, or they may get a couple $100. Now, I don't never recommend buying houses where you're not making zero, or you're making negative, okay, or zero. I don't do that. I like to buy positive, but again, I'm not condoning it because I know people that are just significantly wealthy and they're making so much money, so they buy shitty assets just for tax benefits because their company will own a lot of money. But majority of people are not going to be in that situation. All right. Now, The positive thing about owning wealth builder rental properties is that they go up in value, not because just only of inflation, right? Because the Federal Reserve is printing money left and right, so you know things are getting more expensive to purchase. Uh, but also because there's more demand. They might become a hip area, or more people want to go there because they have better school systems, or there's no more room to grow, or things of that nature. Okay, and so they're going to go in value. So if you look at a 10-year-old span or 5-year span of cash maker property versus wealth maker, that wealth maker property has appreciated. The home value is going up a lot more versus the cash maker. It doesn't matter what state you're in, guys. If you're in California, you're in Texas, you're in Nevada, you're in Colorado, you're in Florida, it does not matter. The thing's going to be exactly the same because the places they're, are nicer. There's not abundance of land to grow. They're just going to go up in price because, economic 101, guys. All right. So these properties are massive appreciation. Now, I don't buy a house just because it's going to appreciate down the line and just because it's going to appreciate. I buy a house because I'm buying at a deep discount. I'm getting massive cash flow. Now I have videos about how to take negative equity houses and make them into cash cows. If you're interested, get on my blog at Mr. No Fluff and watch that. But in this video, I'm just talking about buying positive passive cash flow properties. Okay. Now, why would someone want to do wealth builders versus cash maker? Okay, for me, when I started in real estate in 2006, I had three businesses. I was making money. I wasn't looking for cash, but I had a business that brought me a lot of cash. I was trying to take this cash and build wealth with it. So I bought, A and B type of properties in that depression, uh, and turned to rental properties, and they went up on appreciation significantly. But even that day, when I bought it right, okay, and I already had instant cash flow coming out of it, guys. All right. Now, why would someone want to buy cash maker rental properties? Okay, why would someone want to buy this one? Okay, because they need month. Like maybe they want to quit their job. Maybe they don't have a business and they want to quit the job and they know, hey, they got 100K. They know that if they put 30, 30, 30, and each one gives them $1,000, they could recover their after paying everything off, taxes and insurance, they're going to have a passive income so they can live off of it. Okay. Or maybe they want to have rental businesses as their primary business. Like back in the days, my moving company was my primary business. Rentals were just extra cheese on the dough, guys. Okay. So if somebody wants to make rental business their primary business, then they want to probably get some of the cash makers into their deal. Now, when I first started, guys, into the rental business, so it all depends on where you are and what your personal goals are. When I first started in the rental business, okay, I only bought um, wealth builders homes only. That's all. I didn't buy any cash makers. And now that I look back over it, I wish that I would have bought some more cash makers. It would have made life a lot easier. Okay, because when you have homes that, let's say, makes you only $200 a month or $300 a month or $400 a month on an average, and things go wrong, your profit margin shrinks. Okay, so the next time around, what I'm gonna do is in the next recession that comes in, I'm gonna buy both. I'm gonna buy the ones that give me positive cash flow, a lot of money, right? A lot of money, and I'm gonna get the ones that give me a little money. And these are gonna build wealth. These are the ones that are gonna just transfer over to my kid, and this is the one that I'm gonna use to pay for everyday living. Okay, because they're gonna give me massive cash flow. Now, instead of me going and spending 30K to buy, a house, I'm gonna try to actually do creative financing, where I put, no money down, or I just take over the seller's payments, or I work some kind of creative way to create a note with the seller, where I have the seller become the bank. So the seller becomes the bank. Okay, so I don't even have to throw the 30 grand down. I don't even have to put the 100 grand down. I'm gonna work some kind of deal out where the seller becomes the bank, guys. Okay, and same thing I did, because when I bought these pretty homes, the A and B properties, I did majority of the deals owner financing, where I had the seller deed me the property, I became the owner of it, and the seller carried a note for me, which means the seller became the bank. I didn't have to go to a bank. I didn't have to show them my credit. I didn't have to do any of that. No proof, nothing. I just talk to the seller, I market to the seller, and I teach you how to do that at MrNoFluff.com, dude. I have over hundreds of videos totally free for you guys. And definitely get my book at MrNoFluff.com. It's a free book. You don't have to pay any shipping, none of that stuff. And I truly want to help you guys out. If you're more interested about rental properties, about buying homes, getting passive income, getting owner financing, I highly recommend downloading my Mother course. My Mother course is 171 chapters, over 100 hours of training videos, guys, advanced training videos. I talk about landlording, I talk about owner financing, I talk about different ways to control properties without owning them. I talk about how to get the money if you don't have the money, how to find these sellers, all that stuff, right at MrNoFluff.com. Click on our products and go check it out there. Anyways, to summarize it up, guys, there's two types of rental properties. You have what's called your wealth builders that go up in appreciation. However, they don't give you a lot of cash flow. Okay, maybe a couple of $100, but over time they're going to build wealth. And then you have what's called your cash makers. They don't go up in appreciation, but they give you big chunks of monthly cash flow. Okay, these are cheaper to buy. These are more expensive to buy. However, they go up in prices a lot more than these do. Now, next time around, I'm gonna buy both of these because both of them are great things. Okay, last time around, I only bought wealth builders, and I was very happy with them. Each house I made over 100K when I sold them, but I didn't sell all the properties because I was motivated. Okay, so anyways, guys. If you like these videos, click like, leave a comment. Let me know which one of these properties you like. Do you like cash makers? Do you like wealth builders? Which one do you have? And what do you think about positive, passive cash flow for rental?